Having looked at the technicalities of spot and forward pricing dynamics, we now turn to the fundamental drivers of commodity markets in the short term. As we've already seen, inventories are a critical supply factor in the short term. Given that production capacity is fixed in the short run, it is only the level of stocks of commodity products that can change. Over short-term horizons, inventory levels are a key inverse indicator. When stock levels are increasing, demand is falling relative to available levels of supply, and vice versa. Generally speaking, short-term demand tends to be relatively stable. Buyers' processes require specific product inputs or feedstock. For example, particular grades of wheat or iron ore, or crude oil supplies with closely defined levels of sulfur or sourness, and viscosity or lightness. Buyers across supply chains will be loath to change their processing configurations and, in many cases, may be locked into relatively long-term supply contracts. Seasonalities are also important in some markets in the short term. Agricultural commodity prices are heavily dependent upon growing seasons, as well as the prevailing climatic conditions at each stage, for example during seeding, growing and harvesting. Clear patterns are observed in agri-commodities such as soybeans and wheat, where commodities markets trade around old crops, in other words, already harvested products at some times of the year, and new crops, where the market is trading around goods that are yet to be harvested at other times of the year. New crop markets are generally more risky than old crop markets due to uncertainty around harvests. Net supply and inventories of agri-commodities generally increase just after harvest, and commodity prices are generally particularly volatile around harvest time for each crop, given weather-related and other uncertainties. Other seasonality in commodity markets include temperature-driven variations in demand for energy commodities, particularly coal and natural gas, across winter and summer months. Gold also exhibits seasonality, with peaks of demand observed ahead of the Indian festivals of Dhanteras and Diwali, as well as other occasions. Other important issues that affect commodity markets in the short run include weather shocks, so for example the cyclone season in Southeast Asia, which can affect transportation and have other effects, and the hurricane season in the Gulf of Mexico, which can impact crude oil markets as well as refined product markets such as RBOB gasoline. Power outages, such as those that we've seen in South Africa in recent years, can impact markets such as coal. Unexpected stockouts, for example in copper markets, can create pricing spikes. And shortage of storage capacity, which we saw in April of 2020 in onshore crude oil markets in the United States, can actually turn prices negative, as we saw with the West Texas Intermediary benchmark, as I say, in April of 2020. Geopolitical tensions, such as those in the Persian Gulf or the Levant, impact crude oil prices. And credit markets, particularly as we get to the end of credit cycles, can be important since obviously there's a funding impact there for inventories and working capital across supply chains more generally. In some markets, pure speculation can be important, such as we've seen in lithium and cobalt markets, where we've seen interest, for example, from hedge funds and other traders. The US dollar, which of course is the main pricing currency for commodities, can in and of itself cause volatility within commodity markets if the currency itself experiences uncertainty and resulting volatility.